James, welcome to the show.
Thank you for having me on, Stefan. I'm a big fan and happy to be here.
Yeah, James, I'm a fan of your work. I've been loving some of your work that you're putting out on the Informationist, which is your newsletter. So, listeners, make sure you check out James's newsletter as well as some of your commentary. So, wanted to have a chat with you, just broadly about what's going on. Talk a bit of macro stuff, reactions to recent news, and yeah, chat a little bit about what's why the fiat Ponzi is doomed. So,
Wait, you think there's something going on? Is there is there anything going on in the macro
Oh
world?
well, we better check. But I mean, I think probably the big two items recently are the Fed and the BOE, which both have raised rates by 75 bips. So maybe let's start there. What's your initial reaction there with central banks
With
raising
each of
rates?
those? Yeah. Well, first of all, I'm not surprised at all about the Fed raising 75 basis points. I mean, they've had some conflicting data and nothing that really stands out enough for them to come out to say that they may pause. The thing is they've got they've got a few readings that they're looking at. Obviously, the CPI, and that's been super hot. Unemployment's been super low. It's at near all time lows, and they're watching these indicators. Unfortunately, they are lagging. We all know that, and we can talk about that in a bit. But the Fed has, they have two mandates, and that's maintaining price stability and trying to maintain full employment. So, but the first one is primary, and so they've got to get inflation down. They know this, and they're not stupid. They know that this is a little bit of a supply issue, but if they can get inflation down by crushing demand, they'll do it, and that's kind of what their mandate is right now. So, I think reading from what I heard yesterday, and we'll get into all this with the Treasury and bonds and the issue with the debt spiral that we're all currently in. But the issue with the Fed is they have to raise rates super fast and pretty high, and then pause. We know they have to do this because of the debt, and we can get into that in a minute. But what I think they're going to do is they're going to raise fast, hard and fast, as quickly as they can. We're going to get another 50 basis points in December, and we could get another 50 basis points in January, and then they're step off, step back, and see where we're at. The only thing that would change that is either we get a huge change, a reversal in the CPI or employment numbers, okay, or something happens in the Treasury market. Now, the Treasury market has been a little bit problematic lately. It hasn't broken. It hasn't been, disorderly quite yet, but we are starting to see signs that I think is causing the Fed to take a second look. And his comments yesterday kind of feed into what I'm thinking. Now, Stefan, everything I say is my opinion, unless I give you a fact of
Of course,
numbers or. But we get a lot of people out there who say this is what they're going to do. This is my opinion,
of
and
course, yeah,
and
yeah.
I yeah, and so I think from the commentary yesterday, we heard Powell say, "Look, we have our danger is not raising fast enough and letting inflation get entrenched and out of control. That's the danger." And so he's looking at that and thinking, "Well, I've got the tools." And he even said it. He said, "If I over tighten, I've got the tools to fix that. But if I don't tighten enough, I don't have the tools to fix it if it spirals out of control." And entrenched inflation is something that's very difficult to get out of the system, right? So he's thinking, well, if I raise really fast, really hard, and it looks like we're heading into a recession or we are in a recession, well, I can always print more money. QE, I can lower the rates. I can buy our own bonds. I can stimulate the economy pretty quickly if I do that. And we saw them do that in March of 2020. We saw them do it in 2008. It is a very effective approach. The problem is it's also a very expensive approach. And so we're seeing now we're getting into the spot where, I mean, we're at near QE infinity, and one or two more cycles, and we're just going to have to print to oblivion. So that's kind of how I'm seeing it right now.
Yeah, yeah. And so when you say we're at one or two more cycles and we're going to have to print to infinity, are you referring to like the like broader cycles when you say that, or you mean like a short term cycle?
Well, no, I'm talking about the broader cycles, but those broader cycles are getting the interim is getting shorter and shorter, right? So, 2008, 1998 to 2000, actually 2001 to 2008, then to 2020, and now here we are. When's the next cycle going to be? So, it's hard to tell, but they're getting shorter. And the reason for that is the sheer amount of debt that's on all these balance sheets. So back in 2008, we had the financial crisis, which was a commercial banking crisis and a mortgage banking crisis, right? So what did we do? We stabilized those companies by printing and rescuing them, right? And so we kicked that debt up to the sovereign level. And now here we are in the sovereigns, and basically every G7 that every G7 is now carrying debt to GDP over 100%, except for Germany. And there they have their own issue because they're part of the EU and the Eurozone. And you and I had chatted briefly on DM about Target 2, and yeah, that's going to be a problem because they have structural issues there. So going back to what you were saying about the UK, well, and they just raised rates this morning, 75 basis points. Well, they're still way behind the U.S., a full percentage point behind right now the U.S. And they've got inflation that's above the U.S. It's over 10%, and they're expecting it to come in at 11%. Yet, the Bank of England is saying, don't we think that the market is overestimating the number of hikes that we're going to do and the terminal rate, the highest rate that we get to in this hiking cycle. And so you're seeing then, instead of yesterday we raised rates in the US and then the UK raises rates. Well, that should kind of balance out, right? So you should see in the currency, in the British pound, that should balance out. But the pound is down today against the dollar. And the reason is because of exactly that, is the Bank of England is saying, well, we're not going to raise as much as the Fed is going to raise, basically. And so then you get into forward interest rate parity. And basically the bottom line is if interest rates are higher in the US than they are in the UK, well, there's got to be a balancing factor there. And that balancing factor is the currency. And we can get into that if you want, but
Yeah,
don't want to
sure, sure.
overwhelm your listeners. But
Yeah, sure, sure. So I think the broader context as well is, as you mentioned, this debt spiral, right? This is just the broader, if we zoom out, that's the fundamental problem, that a lot of these governments have so much debt, and it's over 100% in many cases, except for Germany, as you said. Um, and they're getting into a situation where they are going to have to pay a lot of money for that debt, aren't they?
yeah. And so, what I think is going to happen is, like, so going back to the Fed, and the Fed has a problem. It's called the Treasury, and the Treasury has issued so much debt. We have $31 trillion of debt here in the United States, right? So the problem with that is that we're operating at a deficit. So if you we the so the Congressional Budget Office, and they come up with a budget, and you can see it online, and they tell you exactly what they expect, and it's kind of a rosy picture for what we have. And even then, that it's a they're looking through rose-colored glasses. Let's put it that way. And the picture isn't even rosy. And so the problem is that we're operating in a deficit. And so as we continue to operate in a deficit, we have to continue to issue more debt to meet the margin between our tax base and our spending. So to make it easy for your listeners, basically, if you're a company and you are not covering your debt payments, right? So your interest payments, you're generating revenues, and off those revenues, you've got your spending, and one of your major line items is your debt, your interest on your debt, if you're a typical company. And if you're not covering that interest with your earnings, then you have to borrow more, and you're known as a zombie company, right? So you're basically just holding your house up with stilts and hoping that you can eventually grow fast enough and generate enough income to monetize, to pay down that debt. But it's very difficult to get out of that situation as a zombie company. Well, we have the same exact situation in the sovereigns. And so, like we're talking about with the G7s, all the G7s are operating as zombies except for Germany. But Germany, again, has their own issue because a lot of Europe is operating as zombies, and that is on their collective balance sheet in the ECB. So for the U.S., as we're printing more money to monetize, to close that gap, basically, what we're doing is we're issuing debt, right? And we're issuing more and more debt in order to make up that margin, right? But the problem is right now, interest rates are going higher. So as we issue more debt, the interest payments on the totality of our debt is going up. And as we enter this recession and the stock market has completely rolled over, the bond market has rolled over. Well, the problem is that our tax base is also rolling over, right? So the Congressional Budget Office estimated this year that they would take in about $4.8 trillion of taxes, right? But we know that that's a high estimate because that was off the balances back in the spring that they would expect those capital gains taxes, the corporate taxes, the individual taxes. Those are all coming down. So we know that. And at the same time, spending is going up, right? We just had a $300 billion some odd student loan forgiveness package. Who's going to pay for that? Well, we're going to issue debt in order to do that, in order to meet that deficit. So you got $3.7 trillion of spending on mandatory programs, Social Security, Medicare, Medicaid, right? So these are programs that are signed into legislation that can't be changed. And you've got about $800 billion worth of defense spending. So you do the math out. $4.8 trillion of taxes minus $3.7 trillion of entitlements minus $800 billion of defense, and you're left with $300 billion. Well, the problem is they're also estimating that our interest payments are $400 billion. So you're $100 billion in the hole. You're literally a zombie company, as a zombie government. Yeah. So exactly. But at the same time, we just talked about the tax base is coming down, and the CBO just put out a report that said that they expect that the Treasury expects to issue more debt this quarter, and instead of 500 and some odd trillion, it's 700 billion. It's 700 billion. So the number is just rising quickly, and we are in a debt spiral. So the obvious question is, well, hold on, does that mean that we're going to collapse? Is the currency going to collapse? Is the Treasury going to collapse? And the answer is no. The U.S. Treasury is the base. It's the base asset of the world, right? It's a global reserve asset. So it needs to maintain liquidity. It needs to be in a healthy market, or else the entire world, the financial world, collapses. So they'll do what they need to do to make sure that it maintains credibility. That's number one. Number two, what about all the other countries? Well, if you are in a country that your debt is denominated in your own currency, well, you can just print more money in order to make sure that you can issue more debt, because you could just buy your debt. Look at Japan, for instance. They have 250% debt to GDP. So this is a long answer, and I'm sorry,
sure.
I'm just dumping a lot of information.
Yeah, sure. So let me take a second and just summarize some of the key points and put it in simple terms as I understand it. So if we think of the government just like you would a normal budget, they've got money that they take in, tax revenue generally, and money they're paying out, as you said, these mandatory programs, whether it's
Exactly.
welfare state, you name it. And on top of that, they're paying interest out. Now, there's this entity in the US called the CBO, Congressional Budget Office. They are estimating that, hey, we're going to take in 4.8 trillion in tax. But on their outgoing side, and as you said, that's quite an optimistic take, and it may not be that much
Mm-hmm.
given if prices are coming down, there may not be that many capital gains value taxes that the government is going to push or put onto people. And so it basically, we're telling a story here where the government is getting squeezed in a way. Its margins are getting squeezed, and eventually they're going
Yeah.
negative because they're just simply, quite simply, spending more than they're earning. That's just like in
Right.
very simple
So
terms.
what's the choice? So what do? You can either have austerity, right? So spend less. Well, we only talked about the programs that are signed into law. Like these are mandatory payments, right? But there's a lot of other stuff in that they're paying for that are, discretionary spending, right? Outside of the military. So we're over $1 trillion in deficit, right? So you can either cut spending, or which is obviously that's not politically favorable. Nobody likes to have their programs cut. So that's no politician wants to do that. Number one. Number two, you can raise taxes. Also, not typically
Not a
favorable,
popular thing.
but right, not a popular thing unless you only tax the 1%. But the other thing is that actually impacts productivity long term, right? So it winds up your GDP goes down long term if you raise taxes. Then your tax base goes lower, and it's not really effective. And then so the third thing is just issue more debt. That's the other option, and that's the easiest option, and that's the one that we choose every single time. So, of course, there's a fourth option, which is default, but they're not going to do that. We have, again, our debt is based in our currency, so we can just issue more debt, and if we need to, we can buy it. It's as simple as that.
Yeah.
Monetize your own debt.
Yeah. Yeah, I know. Simple as that, right? And of course, what
It's
happens in
crazy,
practice for many countries around the world, because, well, firstly, some countries can't print their own currency because, let's say, they're in the EU as an example, or but
right?
the US obviously has this privilege. And I guess the other factor, longer term, though, is if you are a country doing that, the locals are going to eventually decide, you know what, I'm going to start storing my value somewhere else, or we get this monetary hot potatoes uh, phenomenon because people will decide, okay, I've earned my money, and I understand in Argentina this is a common thing where people earn their money and then they straight away go to the shop, buy what they can because they know the prices are going up very
Right.
very soon. So it's like hot potatoes. You just buy things and quickly, and I think the broader question as well as to why that kind of scenario sustains or keeps going is maybe, yes, there are expectations about a certain level of welfare state or a certain size of the government. And if people are not willing to accept a smaller size of the government, then they end up having social, uh, what's the word, like social disorder, and things happen like
Yeah.
this. And
Sure. Yeah.
maybe they
Yeah.
get
Yeah.
forced. Maybe you can either choose austerity and take the pain now when it's less bad, or wait till it gets really bad and it's forced on you.
It's exactly right. So, and it's kind of what we're seeing in Europe right now, right? So in Europe, they have an energy crisis. They don't have their own energy. They're not energy independent. So the cost of inputs, they're rising. They've risen rapidly this year, and so they have massive inflation out there, and in the UK and other non-European countries in that area. So the problem is, what do they do? Do they institute austerity, and or do they put limits on how much power you can use? Do they put price limits on goods? I mean these things don't work. You know this. Anybody who's studied Austrian economics knows that these things don't work. And so the other choice is to obviously print money. I mean, they're going to have to go back to the printer. So what they're doing in Europe right now, and with the Target 2, to circle back to that. Look, the Target 2 is it's basically a settlement system. It's a payment system between the eurozone at central banks, and they settle their cross border payments, right? At the end of each business day, all the claims and liabilities are cleared, and they're transferred to the ECB, and they're put on what's known as a target 2 balance sheet, right? And so each national central bank, like Italy central bank or Germany central bank or Greece central bank, they'll have a debit or a credit on that target 2 balance sheet, right? But the other thing is that the target 2 also settles all of the ECB monetary operations, right? So their policy procedures. So I mean, we have a similar system here in the U.S. for our Fed branches. It's I think it's called the interdistrict settlement account. But the difference is the balances between the reserve banks here are resolved. They're actually settled regularly. But in Target 2, there's no mechanism for settlement between the Eurozone central banks. And so they're just calculated and noted. So if you look at a chart, and I wrote a newsletter all about this, you can see that the target 2 balances for Germany are, they're owed over $1 trillion from the other banks, and there's a couple that are in positive territory, but there's nobody near Germany, right? And Italy, they actually they have a negative balance of over $600 billion, right? So the problem is there's nothing there to force this settlement, and it's just growing and growing and growing. And then you've got Christine Lagarde comes out, the ECB head. She comes out and says, "Oh, we've got these new tools that we're going to use to make sure that as we raise interest rates, that the weaker economies are not negatively impacted to the point of failure." Right? So Italy, Germany, Spain, Portugal, like they're making sure that their bonds don't the interest rates on those bonds don't rise too fast. Well, how do they do that? They buy those bonds to keep those interest rates low. It's what we're seeing in Japan right now, right? But how do they do that? Well, they use that target 2 balance sheet, and they basically borrow from Germany in order to do this. And they've been doing it relentlessly. And even the ECB itself owes Germany over $300 billion, right? Just think about that. That's kind of perverse, right?
It's insane.
So yeah, it's insane. And so and that just continues on until it doesn't. And, we have a saying on Wall Street, and it kind of goes like this. If you owe the bank $100,000, that's your problem. But if you owe the bank $100 million, well, that's the bank's problem. Right. So, looking at this right now, Germany has a problem, right? So Germany has the problem. They've lent over $1 trillion to these other countries, and that's going to double rapidly and then triple. And eventually, I think, honestly, Stefan, I think they just get fed up with it and they realize they're never going to be paid back, and they're the only one, or one of the only ones, who is running a current surplus, and everybody else is running a deficit. That they're going to walk away. Eventually, they're just going to cut their losses and walk away. So
Yeah.
I don't know when that happens, but yeah.
Yeah. It reminds me of,
It's a problem.
let's say you're a bank and somebody has not made their loan repayments to you. And then you, the bank, you may have a collections team or, some team who has to assess, okay, is this guy going to pay me back or not? And eventually, if they keep coming back to you for credit, and eventually you can't just keep lending to them. You have to cut them off at some point.
Yeah, you just cut the line of credit. Yeah.
Yeah, and so that's the question.
It's an open line of credit, right? So if
Right.
you're the bank, what would you do? Yeah, right.
Exactly. And so Germany right now, and I'm sure as many Germans are unfortunately going through, their industry is struggling with the energy crisis that they're going through. Politically, it must be getting harder and harder for German politicians to just sort of say, let's, and maybe that's a good question for people who are in Germany in terms of what's the political climate there? Like, are Germans okay with just funding the rest of the EU? Like, do they even feel a sense of Europeanness, right? Because I can understand where maybe in some cases where maybe there's like a national identity, maybe there's a national pride, and they're sort of saying, yes, we'll fund them because they're our countrymen. But eventually that breaks down too, right? Because there are people inside Italy who don't even want to be in the same country with each other, or, let alone Germany not necessarily feeling,
Right.
Germans who may not feel like they want to subsidize the rest of Europe.
Yeah, yeah, and that's exactly right. So eventually, it breaks up. Eventually they just get tired of it, and we'll have to see what happens with winter this year and how much that the energy crisis impacts them. Maybe they skate through. It's not that big of a deal. Maybe it doesn't hit for another year. But as it just the debt is not getting any better, right? I mean, they're going to continue to raise rates, and eventually and what that happens it lowers your productivity, it lowers your GDP, so it lowers your tax base. But they're already operating collectively above 100%, debt to GDP. So that's only going to grow. It's very difficult to pay down debt once you're above 100%. And Lynn Alden talks about this, and she explains it very well in that, look, there's you're crowding out balance sheets, right? So who's going to buy that when you have 100+% debt to GDP? Who is big enough? Like what companies, what countries are big enough to buy that debt and swallow it all? And that's the problem, is that you start crowding out a lot of balance sheets that just can't take on anymore.
Yeah.
And which is exactly what we're seeing in the United States right now, which is why, Janet Yellen she's come out and said we're looking at ways to be sure that the Treasury market remains orderly.
Yeah.
And what she means by that is it remains liquid.
Right, as in there are enough bag holders willing to buy and hold the bonds of that government. And I notice one other thing that comes through in some of your newsletter posts is this notion that in some cases, sadly, there are people who get forced to become a bag holder. So in some cases, pension funds, in some case, everyday individuals who have no idea
Mm-hmm.
what that pension fund is doing with their retirement savings. It's actually invested in government bonds, and so the government is able to, let's say, either forcibly or do it in a way where maybe they're not forced, but they don't really understand that that's the default policy, that's the default, and so a lot of people end up being bag holders without knowing it or without a choice.
Yeah, and that's it. That's the thing, is that people say, "Well, who is buying these bonds? Who would buy bonds when they're at 1%, or in Germany, or in Europe when they were running negative yields? Who would buy those?" Well, just exactly what you just said. There are mandates in these funds that, hey, look, if you're a bond fund, you have to own bonds. You have to own a certain amount of government bonds, sovereigns. It's in your investment mandate. And then if you're a pension fund, it's been the 60/40 portfolio it's been very effective over decades in order to meet your liabilities. So when you think about a pension fund, it's basically it's a fund that's set up to make payments to its members when they retire, right? So it becomes a stream of liabilities, future liabilities. So when you're a pension fund, you have to plan for that. Well, it's worked for many years until this year, when everything went upside down, and all of a sudden these bonds are worth far less than they were. They're down 30+% this year, uh, on average, in the United States. And so, these pension funds they're struggling to figure out what to do. And so we saw what happened in the UK, and that's a function of the UK pension crisis, is a function of all this indebtedness. If you just go down the line of what happened, um, like we're saying, that the pension fund needs to make these future payments, and they have to plan for that. Well, they only have certain assets that they can invest in, right? So they're not investing in NFTs, right? So they're investing in real estate and equities and bonds, but they've got a certain amount of risk they can take on, and they've got a certain amount of volatility they can take on. And for many years, the lowest volatility and lowest risk instrument has been bonds, right? Especially sovereigns. And so they bought those, but the interest rates have been manipulated so low, and held so low by central banks for so long that they couldn't generate enough growth and income to meet those future liabilities. So what did they do? Well, they used what's called liability-driven instruments to meet that margin. And those, so Stefan, those are not bad in and of themselves. They're just swaps. And swaps can be great because they can help you hedge out certain risks. If you have a floating rate interest risk in one of your investments, for instance, okay, so say you have a real estate investment that's floated, it's a floating rate. Well, what you can hedge that out with a fixed interest rate that you can plan around, okay, using one of these swaps, these liability driven instruments. Or if you have a currency exposure, you can hedge that out, right? So that's good. But it opens the door, being a swap, it opens the door that you only have to put down so much collateral to own that swap, right? And when I was running my hedge fund and doing swaps for risk arbitrage, we could put down 5-6% on those and lever up 20-1 on those if we wanted to. And just think about that, right? So you're levered 20-1 and you've got this only 5% collateral. Well, I won't get into the math because I don't want to get too complicated here. But the bottom line is, in the UK a few weeks ago, when the new finance minister came out with this unfunded tax plan, this huge tax reduction that was unfunded, like it shocked the market. And so investors looked at that and said, well, these bonds, the only way they're going to be able to pay for that is by issuing a whole bunch of new debt, like massive amounts of debt. And these bonds that I own are going to be worth way less. So I'm going to sell these, right? So investors started selling gilts. Well, what happened was you had these pension funds who were using these LDIs and then leveraging them up in order to get a better return, right? So if you get, instead of getting a 1.5% return, if you lever it up 3-1, 4-1, 5-1, you could get a 7, 8, 10% return on that, right? So, net out your cost of the leverage, but suffice to say, you can get a better return. And that's what they were doing to try to meet those future liabilities. But as investors sold those gilts, they went down. They went beyond that point that would trigger a margin call for the UK pensions. And then those pensions got a margin call and had to sell the gilts. So it kind of snowballed, right? And the Bank of England stepped in because the pension funds basically went to the Bank of England and said, hey, look, if you don't step in, we're literally going to default. We're going to be bankrupt this afternoon. And so they did. They stepped in and bought gilts in order to hold that price at a certain point.
Yeah.
It's madness. At the same time that they're raising rates and trying to sell the gilts themselves off their own balance sheet. So
Yeah, it is kind of crazy, and I think let's say the parallel from the Bitcoin or crypto world is I'm sure people are familiar with platforms like BitMEX, and people joke about, oh, you got wrecked on leverage on BitMEX, but now we're kind of in this weird situation where these big pension funds are effectively getting wrecked on leverage, and they need someone to step in and bail them out. And maybe it's not a direct bailout, but it's more like an indirect form. But
yeah,
it's quite an unfortunate scenario where in some ways it's people wanted a certain level of stability, right? They just wanted this idea of, oh, I just put this money away, the pension fund will just give me that 8% return, and by the time I'm ready to retire, oh, the money's there for me. And they've got either an annuity for me, or they have, right, the value of my policy or my plan has risen to the level that now I can retire on it. And so it's like society just bet on that idea, right? Like they just bet
yeah,
on this idea that they could just get this kind of 7-8% return in real terms, obviously, not even thinking about inflation here.
in perpetuity, right? Yeah,
Right.
yeah,
And they just kind of
yeah,
thought, well, yeah, you know what? We can do that. Um, but at the same time, right, that's one side of it. And then at the same time, you have these central banks who are playing this kind of up and down game, where, historically, people, when in the time of Bernanke, they used to call it the Bernanke put, right? There's this idea that,
That's
oh,
right.
see, Bernanke will save me. So I'll just, BTFD, as the saying goes. And that seems to have been the way the financial professionals and the financial market just treated things.
And now everybody's expecting it. That's the problem, is that they've conditioned the markets, all of these major developed markets. They've conditioned them to expect the put, and so the equity markets are you can see them. They're like buying ahead of every word that Powell says or Lagarde says. They're like, is the put coming? Because they want to get ahead of it, because they know once that put comes, they print more money, and that's as long as it gets into the broader money supply, it's inflationary and asset prices go up. They know that. So that's the problem, is they've conditioned it. But going back to what you're saying is, yeah, it's sick, Stefan. It's sick that these pensioners, and hey, God bless you. If you have a pension, man, what a deal. I mean, like, I don't, Gen X doesn't have a pension for by and large. And, my kids are not going to have a pension, but for those who were part of that system, you know, you bought into, you trusted, you believed this. Well, it almost got blown up. Number one. Number two, it is getting blown up because it doesn't matter. You're going to get paid back these pension dollars. They're not going to be worth anything near what you thought they were going to be. So if you thought that you could retire on $500,000 or $1 million worth of future pension payments, probably not, because the inflation is happening so rapidly. I mean, I put out a post the other day. It's like, if I remember the numbers correctly, in 5 years with 5% inflation, if you don't get a raise, you either need you either need a 28% pay raise, or you need to work an extra 40 hours a week. So if you work 40 hours a week and there's 5% inflation for 5 years, you need to work a whole extra week every month.
It's crazy.
So it's nuts. Like, it's so wrong, which is why you and I and others are so vocal about the fact that we have to fix this problem. And the one thing that we see, the one light, the shining light that we see that could fix so many of these issues. Will it fix them all? No, there are always bad actors everywhere. But Bitcoin can fix these, and if we could just somehow get on that parallel path of using Bitcoin as a reserve asset, I think that a lot of these problems can be fixed. The indebtedness can be, we can bring that way down. So it's hope, anyways,
Right. I
right? So
see you. Yeah.
all this turmoil we're talking about, at least is hope.
Yeah. And I think we're still extremely early in the journey, because even people who hold Bitcoin, they may be seeing it more like, oh, I'll just put a small speculative sort of punt into Bitcoin. When we haven't seen the paradigm shift enough to where people are actually pricing in Bitcoin, or at least at scale, right? There are small pockets or examples I could give you where people literally price in Bitcoin, and
Mm-hmm.
not just like fiat convert at the time, like actually price the service in Bitcoin. Like, that's
Yeah,
a very, very
it's kind of
small.
like when you learn a new language, are you thinking in that new language,
Right.
or are you thinking your language, translating it, and then translating it back, right? So yeah, it's the same. That's the same
Yeah.
kind of concept. Yeah.
Exactly. And I think that's actually something, if you're a hardcore Bitcoiner, it's actually useful for you and I and people like that to actually try at least to think in Bitcoin terms, right? So if you're spending, and so what I might do is I'll look at the sats per dollar price and say, okay, if sats per dollar is 5,000, I'm buying, and you're buying a $3 coffee, okay, it's 15,000 sats, and so over time
Right.
you can start to try at least shift your thinking. And it's almost like front running, or just trying to get ahead of where we think the ball is going, right?
Right.
Of course,
Yeah.
it takes time to get there, and not everybody can price things in sats. But certainly, I think it's fair to say people who valued their net worth in Satoshi terms or in Bitcoin terms over the years have done so well, right? Like if you look back historically, people paid, maybe 20 Bitcoin for like an iPhone, 5 years and years ago. Whereas nowadays you can
Right.
buy many iPhones for one Bitcoin. So it is improving over time, but obviously it's a slow process. But I think, as we're talking about government debt and these, basically this debt spiral that the world is living in, and I guess one other area that I'm curious to get your thoughts as well. There is a school of thought amongst some macro commentators, and so probably notably people like Jeff Snyder, as an example, where they argue
Hmm.
central banks don't really matter, and actually it's a shortage in, let's say, the euro dollar market or things like this. I'm curious your view. Do you agree, disagree with that view? Because it kind of runs counter to this idea that the central banks are in charge. In a way, that thesis is sort of saying the central banks don't even have the control here.
Well, I mean, the Eurodollar market is so big and unwieldy, it's hard to really imagine, right? And it really all comes down to the US dollar and the need for them, right? So there is a structural problem there for many countries, and you can see it that as the US dollar becomes stronger and stronger. And for these countries that don't denominate their debt in their own currency, if they have to use dollar based currency, it crushes them. So that's where it goes into the dollar milkshake theory. Brent Johnson from Santiago Capital. And for your listeners who don't know what that is, it's basically, it just says that it comes from oil drilling, right? Where you buy a piece of land next to somebody who has a great oil field, and then you drill a long hole to dip into their land and suck some of that oil out. That's the straw, right? So, and Brent's analogy there is, look, the U.S. dollar is sucking other currencies into it, because the straw itself is that U.S. dollar denominated debt and liabilities and cross-border payments, and so they need to buy U.S. dollars, and eventually the dollar just swallows them. And so that's kind of the dollar milkshake theory. The milkshake is the other currency. The straw is all the U.S. dollar denominated debt and liability, and the drinker is the dollar, U.S. dollar. So yeah, it produces many structural issues. And so the question is then, well, how does the Fed impact that, right? Well, there's no doubt about it that there's a interest rate parity issue between central banks. So we're seeing it in Japan, for instance, right now. Like, we're watching it real time in Japan. The Bank of Japan has diverged from the U.S. Fed, right? So the U.S. Fed is raising rates, and the Bank of Japan is doubling down on QE, and they're holding their rates at a certain percentage. Their 10-year, they're holding at 0.25%, and their short term, they're holding it even below zero, right? So, but looking at the 10-year, which is kind of that's the benchmark treasury, right? So if you look at the U.S. 10-year, and you take the spread between the U.S. 10-year and the Japanese 10-year, and you plot it, and then you plot the yen against it, you can see that it has followed perfectly what the dollar has what that spread has done over this past year. And why is that? Well, it's interest rate parity. If you can get a better interest rate in the U.S. than you can in Japan, then you're going to sell that Japanese denominated security. You're going to receive yen. You're going to sell those yen. You're going to receive dollars, and you're either going to stay in dollars, or you're going to buy U.S. Treasuries, right? So either way any way you look at it, there's pressure on that Bank of Japan Treasury, those JGBs, right? So Japanese government bonds. But the release valve is the currency, because there is pressure built up, and there's got to be some place for it to go, and that's it, and that's what's happening. So it's not that in that situation, it's not really a shortage of dollars. That's just the parity. So I think there is some truth to what he's saying, and there's no doubt about it. there's a shortage of dollars around this world because of all those euro dollars we're talking about, that US dollar denominated debt. And we don't even know how much is out there, right? So like if if you borrowed $100 from me, right? We're out to dinner. I pay for it. I'll pay you back. Okay, cool. Well, that's an asset for me and a liability for you, right? But nobody else in the world knows that. But that's what's happened, and that's
Yeah.
kind of what other banks are doing around the world, and that's the issue. So
Yeah. Yeah. That makes a lot of sense. And I think crucially, the point in the difference is that debt I have to you is not really something that you would go and trade about liquidly at par, because it's not really it's not a liquid receivable. It's just $100 owed from Stefan, right? Like, but
you're good
I
for it,
think,
though. You're
yeah,
good
yeah,
for it.
I'm good for it. I'm good for it. So value me at par, guys. Um, but I think what the whole euro dollar phenomenon is also this idea that if other people trade around claims like IOUs at par, and I think maybe that's where it's going. But I think to kind of bring it back to the Bitcoin idea, is it's just that Bitcoin offers another thing that you can hold. It's another thing that you can store your value into. So at least that's how I'm seeing it. So whether you are an individual or whether you are a company, some of these people or companies are currently holding US treasuries, or even non-American companies do this because they might want to be, holding some amount of bonds. And so from my perspective, the process of Bitcoin adoption is more and more people taking the orange pill and realizing, oh, instead of holding government bonds, I'm better off holding Bitcoin. Whether you're a business
That's
or an
right.
individual, a country, I think that is actually this process. Now, of course, eventually, as we get later stage, people will price in satoshis and use it all as a day-to-day currency. We can use the Lightning Network, and I'm all about that too. But I think fundamentally, that's the process: is more people holding Bitcoin and saving with Bitcoin. That's how I'm seeing it. So I'm curious, any reactions you have, or agree, disagree, or how are you
I
seeing that?
totally agree. Yeah, no, I totally agree. I think that's where it goes. We run a parallel system of U.S. Treasuries, uh, maybe some gold, but also Bitcoin, and um, as a reserve asset for people and for institutions and for sovereigns. And so, but from my point of view, coming from the institutional investing world, I mean, I can see how how these the how institutions will eventually start treating Bitcoin in particular as a separate asset class. And so we're starting to hear, institutions figuring this out, whether it's Fidelity or BlackRock, but if you think about it, there last year there was $700 trillion of investable assets. It's closer to 600 now. But just using those numbers, if you look at this and you think about, what if you're looking at this as a separate asset class and you're an asset allocator, you're an institution, right? I mean, I've said this recently, but there's five asset managers that control $30 trillion of that $600 trillion of assets. You've got BlackRock, Vanguard, UBS, Fidelity, and State Street, and then there are some that are really close: Morgan Stanley, J.P. Morgan, Allianz. These these firms control so much of the money, right? And they're sniffing around. They're putting in place uh, ways for not just their customers and not just their investors, but their actual portfolios to own this as a separate asset class. But once they determine that this is what you, like you say, a store of value, which will take time, but once they start doing that, and then they put 1% of their funds into this, well, everybody's going to have to follow. You can't not follow Fidelity and BlackRock and Vanguard. Like, these are Fidelity and Vanguard, they manage a massive amount of retirement accounts, right? So, and individual accounts. So once you have that, just 1%, just a 1% allocation from those guys is $300,000 Bitcoin, you know? And as it grows, it gets to 3%. You're nearing a $1 million Bitcoin on just today's assets. But we know those dollars are inflating, and so it's hard to really talk in those terms, like you said, when you talk in Bitcoin terms, But eventually, I think what happens is it just starts taking some of that asset allocation from bonds. It's already taking some from equities. It takes some from real estate and from art and collectibles and from gold, because individuals can buy any amount. So I get this question sometimes: why do you say that it's good to buy gold or Bitcoin as a store of value? Well, Bitcoin's in my opinion, the hardest money out there. Um, I don't believe in anything 100%. I'm a risk manager, so I can't help that. But they asked me, why don't you believe in real estate? There are a lot of reasons, but one of the reasons that people like you and me recommend Bitcoin for people is you can buy $100 worth. And where can you buy $100 of real estate?
Right. You have to buy some
You
REIT or
can't.
something, and even then, maybe that's not accessible to everybody. You have to be able to access a brokerage account or something similar.
Yeah, exactly. So yeah, and I agree. But I think that's how it happens, and it happens gradually over the course of the next 5 to 7 years. That these companies come around, these asset allocators come around, and they figure it out. Maybe it's 3 to 5 years, but we've
Yeah.
got a trough here that we're in. You know, and that's kind of stifling things. So
Right, and in fairness, Bitcoin has been through cycles before, and I expect more cycles to come. I don't think, um, the next bull cycle is the final cycle. I think there's going to be a few of these to go, and there will just be that process of people, institutions, even governments just getting comfortable with the idea of using Bitcoin. Obviously, some people will get it before others do. Obviously,
mhm.
people like Michael Saylor or El Salvador are going to be very publicly some of the first in their, let's say, category or bracket. Um, but it'll take time, and I think people have to sort of see Bitcoin weather some of these cycles before they get comfortable. And the way I'm seeing it is that for a lot of people, you have to go through a bear cycle and have it sort of extended in a either sideways or bear for a while, and then see it come back again before you sort of put your own confidence in it. And maybe that's we can't avoid
Yeah,
that. Maybe that's just how it has to go down. But I think there are different conversations we see. So some people say, "Oh, see, it's regulatory clarity. We need regulatory clarity, and that's going to bring people in." And of course, as a libertarian, I want to try to minimize regulation, minimize taxes as much as possible. I would rather not. I'd rather people just build up their own confidence over time. But it seems that for some people, that is going to be the hurdle in their mind. And I don't wish it was that way, but it seems for them that's the hurdle. But
I
for
think
others,
no, I
yeah,
do. Yeah, I think for institutions that's a hurdle. I don't think as much for individuals, but I think for institutions it is a hurdle. Why? Because it's cover your own ass, right? You need to be sure that you're not stepping into something that you don't fully understand from a regulatory standpoint.
right.
And so that it's really a risk mitigation for them. But once they get that, I think that does help institutions. Do we need institutions for Bitcoin to be widely adopted? Well, we don't need them to lead it, but eventually they'll have it, or they'll go away, right?
Right.
So either way. So do we need them for it to be adopted? I don't think so, but it really would help drive it much faster, in my
I see.
opinion.
Yeah, and I can
So
imagine the conversation that, let's say, a professional finance professional might have with, say, a family office, even a high net worth or ultra high net worth family office. For some of those people, unless the high net worth individual himself is into Bitcoin, it's going to be a hard sell for that family office to then say, "Oh, hey, this guy presented Bitcoin to me. Let's go for that." And you know, I think part of that, in a way, is a reward for people who are open minded. I think you have to be
mhm.
at least a little bit open minded to get into Bitcoin today. And so I think that's one factor. And I think honestly, for some people, it's just technological either apathy or laggardness, right? So even in the fiat world, there are people today who could get a bank account and credit card, but they choose to operate in cash, right? And so if it's hard enough to get them into the fiat banking system, like imagine how much more it's going to be to get them into Bitcoin
Yeah,
and use Bitcoin wallets and all of this. So I think the fundamental point I see is, yeah, you have to be open minded, but we also have to be patient. That it's just going to take time. And I think maybe we get overly exuberant in the bull cycles and then overly bearish in the bear cycles, and it's not as useful. Whereas if you are sort of staying on brand, staying on message, that's the way.
Just dollar cost average in all the way along, and you'll be fine. You will be fine. Yeah,
Yeah,
and it does. It's going to take a long time, but I'm with you. I think that that eventually we just get the confidence through these cycles. More and more people hold it through the cycle and understand it and see it, or regret not holding it through the cycle and
right.
see it didn't go to zero.
Yeah, or they see their friend who did well in it. Now they're jealous, right?
Yeah, exactly. So yeah, I
Yeah,
agree.
yeah,
And that gives us hope.
yeah.
100%. Yeah.
So I guess one other question people are thinking now, maybe it's fair or unfair, but there seems to be this idea that a lot of people are kind of waiting for the big Fed pivot, right? That's kind of like this
Hmm.
narrative out there. Now, of course, as I've mentioned before, and I think in general, as Bitcoiners, we would rather believe that Bitcoin marches to the beat of its own drum, but maybe that's not the reality. I'm curious your thought on this idea of a so-called pivot. Uh, do you believe it has to come eventually?
Well, yeah. Going to the debt spiral problem. The problem is that the Fed can't keep rates high like they did. We're not going to have Powell. Powell's not going to have a Volcker moment. He's not going to be able to raise rates above 10%, 12%, 15%, 20%. It's not mathematically possible without completely bankrupting, destroying the treasury. You can't do it. And we talked about it. Think about 10% interest rates on $31 trillion. Your largest line item obviously would be your debt payments, your interest payments. It's just ridiculous. So that's not going to happen. Um, so, but because we know that they can't keep rates high for long because of that debt, then they have to pause and they have to pivot. They have to bring those rates back down. And really, the real game here, Stefan, in my mind, is that the Fed they declare victory on inflation because they say that it's reversed. Okay, it's reversed. It's under 6%, but they let it run hot between 4 and 5% for a while. And that allows them to generate a higher GDP for the Treasury in order to have a larger tax base in order to pay down some of that debt or at least decrease the amount that they're borrowing in the future and just kick that can down the road. That makes the most sense to me mathematically and financially for them to do, is to just let inflation run a little bit hot, not so hot that you realize that you're being boiled, but just turn up the heat a little bit. And people don't realize that 5% will impact them massively, but it'll help the Treasury. It'll help them pay down some of that, or keep that debt under control for a little while. Then that's the game. That's the game they're going to play. So
Yeah, I think it's an interesting way of summarizing and clarifying things. So, probably a good spot to finish up here, James. But listeners, make sure you follow James. You can find him on Twitter at James Lavish, and the newsletter is jameslavish.substack.com. So, James, great to chat with you, and thank you for joining me.
yeah, awesome to talk with you as always, Stefan. Look forward to seeing you the next conference.
Fantastic.